Key concepts: Perpetual Inventory Control System, Periodic Inventory Control System, FIFO, first in, first out, LIFO, last in, first out. Weighted average. Assessment criteria. The difference between a perpetual and a periodic inventory control system is explained. The calculation of the value of cost of sales and gross profit is explained. 7.1 Introduction. Most business entities carry inventory, so it is important that you have a clear and full understanding of how to account for it. This not only involves ledger account entries but also the valuation and presentation of inventory in the financial statements. In most cases, inventory is the largest current asset of a trading entity. It is important that a trading entity is always able to supply the demand for its different types of merchandise. For that reason, trading entities keep a supply of inventory that is constantly replenished and from which sales are made. This means that the expenditure of funds on the purchase of inventory during a particular period will not always equal the cost of the goods that are sold during the same period. In determining the profit of a trading entity, it is thus important to determine the cost of the goods that were indeed sold during a period. This is known as the cost of sales. The cost of sales and the cost price of inventory on hand can be determined according to one of the following two inventory control methods: Perpetual Inventory Method, Periodic Inventory Method. 7.2 Inventory Valuation Methods. When an entity purchases various batches of an inventory item at different prices, and not all goods are sold during the year, the question arises as to which of the prices paid for the batches should be the purchase price of the batches still on hand. The method used to allocate costs to inventory and to determine the cost of goods should be the one that brings about the most realistic determination of profit in the particular entity. The three most used valuation methods in practice are the following. First in, first out, FIFO, method. According to this method, it is accepted that the items which were purchased first are sold first. Inventory on hand is therefore valued at the latest prices. Last in, first out, LIFO, method. According to this method, it is accepted that the items which were purchased last are sold first. This method falls outside the scope of this module and therefore will not be discussed in any examples. Weighted average method. The total cost of the goods available for sale is divided by the total number of units to determine an average cost per unit. 7.3 Inventory Control Systems. Inventory systems refer to the way in which inventory is recorded in the accounting records of a trading entity. 7.3.1 The Perpetual, Continuous, Inventory Control System. Under the perpetual inventory system, the purchase of inventory is recorded directly into the inventory account at cost price. At the time of sale, the cost price of goods sold is transferred from the inventory account to the cost of sales account. The accounting entries under such a system can be summarized as follows. VAT is ignored in these examples. Purchase inventory for cash. Debit inventory, because the asset inventory increases. Credit bank, because the asset bank decreases when money is paid out. The transaction is recorded in the cash payments journal at cost price. Purchase inventory on credit. Debit inventory, see above. Credit creditor, individual, because a liability is created or increased. Credit trade payables control. The transaction is recorded in the purchases journal at cost price. Sale of merchandise for cash. Debit. Bank. An asset increases with money received, selling price. Credit. Sales. An income which increases equity, selling price. Debit. Cost of sales. An expense that decreases equity, cost price. Credit. Inventory. An asset decreases, cost price. The transaction is recorded in the cash receipts journal. It is important to note that the difference between the cost of sales and the selling price is the gross profit, which is the amount by which the equity increases. Merchandise sold on credit. Debit debtor, individual, an asset is created or increased, selling price. Debit trade receivables control. Credit sales, see above, selling price. Debit cost of sales, see above, cost price. Credit inventory, see above, cost price. The transaction is recorded in the sales journal. When merchandise is returned by a debtor. Debit. Sales returns. This has the opposite effect of sales on equity, it decreases equity, selling price. Credit. Debtor, individual. The asset decreases because the debtor owes the business less, selling price. Credit trade receivables control. CR cost of sales, this has the opposite effect on equity to the effect when merchandise was sold, cost price. Debit inventory, the asset increases by the amount of the merchandise returned. Cost price. The transaction is recorded in the sales returns journal. Merchandise returned, previously sold for cash. If the entity has a policy of not repaying cash, a credit note will be issued to the client that can be exchanged for other merchandise. If the business is willing to refund cash. Debit sales returns, see above, selling price. Credit bank, the asset bank will decrease to cancel the previous increase. Selling price. The transaction is recorded in the cash payments journal. To reinstate the merchandise as part of the inventory. Debit inventory, the asset inventory increases, cost price. Credit cost of sales, see above, cost price. The transaction is recorded in the general journal. When merchandise is returned to a creditor. Debit creditor, individual, because the liability decreases, cost price. Debit trade payables control. Credit inventory, an asset is decreased, there is less inventory because of the goods returned, cost price. The transaction is recorded in the purchases returns journal. From the above discussion, it is clear that the cost price of merchandise sold is recorded at the same time as the sale of the merchandise. This procedure enables the entity to determine the gross profit on each sale and to keep a continuous record of the rand value of the inventory that has not yet been sold. However, it remains necessary to do a physical inventory count at least once a year, usually at the end of the financial year. Theoretically, the result of the inventory count should yield the same result as the balance on the inventory account. This seldom happens. Some of the main reasons why there is a difference are the theft of inventory, breakages, leakages, and evaporation. This loss of inventory will, of course, not be recorded in the inventory account and will only be detected when a physical count of inventory is done. 7.3.2 The Periodic Inventory Control System. Under the Periodic Inventory System, the purchase of inventory is not recorded in the inventory account. A separate account, known as the purchases account, is used to record these purchases. It follows that if inventory is returned to the seller, for one reason or another, the return of inventory cannot be recorded in the inventory account but must be recorded in a separate account known as the purchases returns account. It should thus be clear that under a periodic inventory system, the cost of sales is not determined at the time of the recording of the sale. The cost of sales can thus only be determined at the end of the financial period after a physical inventory count has been done. The cost price of inventory sold during an accounting period will thus be determined as follows. Cost price of inventory at the beginning of the financial year, closing inventory of previous year. Add, cost price of inventory purchased during the financial year, the total amount spent on purchases. Less, cost price of inventory at the end of the financial year, determined by a physical inventory count, the unsold inventory. The accounting entries associated with a periodic inventory system can be summarized as follows. VAT is ignored in the examples. Purchase of inventory for cash. Debit purchases. Under the periodic inventory system, purchases are regarded as an expense that reduces equity. Credit bank. The asset bank decreases when money is paid out. The transaction is recorded in the cash payments journal at cost price. Purchase of inventory on credit. Debit purchases, see above. Credit creditor, individual, creditor is a liability account which is created or increased. Credit trade payables control. The transaction is recorded in the purchases journal at cost price. Sale of merchandise for cash. Debit bank, the asset increases with the money received. Credit sales, an income account which increases equity. The transaction is recorded in the cash receipts journal at selling price. Sale of merchandise on credit. Debit debtor, individual, an asset which is created or increased. Debit trade receivables control. Credit sales, see above. The transaction is recorded in the sales journal at selling price. When merchandise is returned by a debtor. Debit sales returns, equity decreases. Credit debtor, individual, the asset decreases. Credit trade receivables control. The transaction is recorded in the sales returns journal at selling price. Merchandise returned, previously sold for cash. The policy of the entity would determine whether a credit note will be issued, refer to the perpetual inventory system, or whether the cash will be refunded to the client. The entry for a cash refund will be as follows. Debit sales returns, the equity decreases. Credit bank, the asset bank will decrease to cancel the previous increase. The transaction is recorded in the cash payments journal. When inventory is returned to a creditor. Debit creditor, individual, the liability decreases. Debit trade payables control. Credit purchases returns, the actual purchase is reduced. The transaction is recorded in the purchases returns journal at cost price. Physical inventory count at the end of the financial year. Debit. Inventory. An asset account which is created with the inventory on hand at the end of the financial year. Credit. Trading account. A nominal account which is used to determine the gross profit, and which increases equity if a gross profit is made. The transaction is recorded in the general journal. From the above summary it is clear that, under a periodic inventory system, there is no cost of sales account but a purchases account, and that the column headings of subsidiary journals will have to be adapted to accommodate this inventory system. Some of the accounts kept in the general ledger will also have to be changed when the periodic inventory system is in use. It is very important in assignments to make sure that you know which inventory system an entity uses, as this will determine how the subsidiary journals and the general ledger will be laid out. 7.4 Additional purchase costs. Carriage on purchases and railage are examples of expenses that an entity may have to pay to transport the inventory which has been purchased to the entity's premises. Custom and excise duties may also have to be incurred when inventory is imported. When the perpetual, continuous, inventory system is used, carriage on purchases, and the like, are debited directly to the inventory account, since the cost of sales must be brought into account with each sales transaction, and carriage paid on purchases constitutes an integral part of the cost per unit. When the periodic inventory system is used, all purchases of inventory during a financial year are debited to the purchases account. Consequently, this account will show the total of all purchases at the end of the financial year. Carriage on purchases, paid for in cash, as well as on credit, by an entity which uses this inventory system, will be debited to the carriage on purchases account. This account will show the total amount spent on transporting inventory to the premises of the entity. When the cost of sales is calculated at the end of the financial year, carriage on purchases must also be included. Custom and excise duties will be treated in a similar manner. The following illustration will demonstrate how accounts under the different inventory systems will be affected when additional purchase costs are incurred. Transaction. Perpetual inventory control system. Periodic inventory control system. Doctor inventory. Doctor carriage on purchases. Payment of delivery. CR Bank. CR Bank. Costs on inventory. Or purchased. CR creditor, individual, and trade payables control, if on credit. CR creditor, individual, and trade payables control, if on credit. Use the following information from the books of go-go dealers to calculate the cost of sales. R. Inventory, January 1, 20.1. 95,000. Purchases. 260,000. Carriage on purchases. 3,600. A physical inventory count on December 31, 20.1 indicated that inventory on hand amounted to R80,000. 2. Solution. Inventory, January 1, 20.1. Add, purchases. Carriage on purchases. R. 95,000. 260,000 3,600. 358,600. Less, inventory, December 31, 20.1, cost of sales. 80,000. 278,600. 7.5 Drawings and donations of inventory. Drawings and donations of inventory are recorded by means of the general journal at cost price. Please study the following table carefully. Transaction. Perpetual inventory control system. Periodic inventory control system. Inventory taken by the owner for personal use. Doctor drawings CR inventory. Doctor drawings CR purchases. Donation of inventory. Doctor donations CR inventory. Doctor donations CR purchases. When an entity is registered as a VAT vendor, drawings and donations are not exempted from VAT. The VAT is, however, calculated on the cost price and must be credited to the VAT output account. 7.6 Settlement discount granted. Discount is often offered to debtors to encourage a quick settlement of their debts within the stated credit term. The credit term will be shown on the credit invoice, for example 30 days from date of sale. This means that if a debtor pays off his/her account before 30 days from date of sale, the debtor will receive a discount on the total amount owing. The accounting entries associated with the periodic and perpetual inventory systems can be summarized as follows. Debit settlement discount granted. The account is an expense that reduces equity. Credit debtor, individual account, and trade receivables control. The asset account debtor/trade receivables control decreases when a settlement discount is granted. At the end of the financial year, you will close off the settlement discount granted account to the sales account in the general ledger. 7.7 Settlement discount received. When creditors are paid within a specified period according to an agreement, the entity may get a discount on the outstanding amount. We refer to this discount as the settlement discount received. The accounting entries associated with the periodic and perpetual inventory system can be summarized as follows. Debit creditor, individual account, and trade payables control. The creditor/trade payables control account is a liability, and it decreases when a settlement discount is received. Credit settlement discount received. The account is an income that increases equity. At the end of the financial year, you will however close off the settlement discount received differently under the perpetual and periodic inventory systems. The accounting entries associated with the periodic inventory system can be summarized as follows. Periodic inventory system. Debit settlement discount received credit purchases. The accounting entries associated with the perpetual inventory system can be summarized as follows. Perpetual inventory system. Debit settlement discount received. Credit cost of sales. 7.8 Carriage/freight charges on sales. The freight or carriage charges on sales account is an expense. This is the cost of transporting the goods sold from the selling entity to the customer, and therefore it is an expense to the selling entity. Carriage/freight charges on sales will therefore be treated as an expense in the selling entity's statement of profit and loss and other comprehensive income. 7.9 Markup on cost. Cost of sales is the cost of the goods that were sold during a period. The markup percentage on cost is the gross profit percentage of the cost price. Therefore, to calculate the cost price when the markup percentage and selling price is given, you will use the following formula. Cost price equals selling price x 100 divided by 100 plus markup percentage on cost. Let us look at the below examples. 3 Comprehensive Example 1. BS Hardware sells a ladder for R390. The markup percentage on cost is 30%. What is the cost price of the product? Markup percentage on cost. Selling price equals 30%. Cost price plus markup percent on cost. Cost price equals 100% equals R. Selling price equals 130% equals R390. Cost price equals 100x R390. 130 equals R300. Comprehensive Example 2. You are supplied with the following source documents from BS Hardware. BS Hardware is registered as a VAT vendor. All the suppliers of the entity are also registered for VAT. All goods are sold at a constant markup of 25% on cost in a perpetual inventory system is in use. 4 required. Prepare the following books of prime entry for BS hardware for June 20.8, and make use of the column headings as indicated. BS hardware. Purchases Journal, June. Purchases Returns Journal, June 20.8 PRJ. Sales Journal, June 20.8 SJ6. Sales Returns Journal, June 20.8 SRJ6. General Journal, June 20.8 GJ6. Post the journals after closing it to the appropriate accounts in the General Ledger, Trade Receivables Ledger and Trade Payables Ledger. Balance all accounts. Prepare the Trade Receivables and Trade Payables lists. Solution, Comprehensive Example 2. BS Hardware. Purchases Journal, June 20.8 PJ. Purchases Returns Journal, June 20.8 PRJ6. Sales Journal, June 20.8 SJ6. Sales Returns Journal, June 20.8 SRJ6. General Journal, June 20.8 GJ6. Additional information. The above example is similar to Comprehensive Example 2 from Learning Unit 6 on credit transactions. However, in the previous example, the periodic inventory control system was used, hence, inventory in trade was debited to the purchases account. In the above example, the perpetual inventory system is used. Inventory in trade is debited to the inventory account and an inventory column is required instead of a purchases column in the subsidiary journals. When inventory is bought or returned, the entries for the transactions will affect the inventory account in the general ledger as the use of a purchases account and purchases returns account is not permitted when a perpetual inventory system is used. 7.10 Exercises and Solutions. 5. Exercise 1. The following information was obtained from the records of Pioneer Traders for the financial year ended February 28, 20.3. The entity applies the periodic inventory system. 6 required. Calculate the cost of sales. Exercise 2. The following information was obtained from the records of Cool Traders for the financial year ended February 28, 20.4. A physical inventory count on February 28, 20.4 indicated that inventory on hand amounted to R145,000. The periodic inventory system is in use. 9 required. What is the cost of sales amount for the year ended February 28, 20.4? Which amount represents the gross profit figure for the year ended February 28, 20.4? Self-assessment. 242. After you have worked through this learning unit, are you able to explain the difference between a perpetual and a periodic inventory control system? Correctly calculate the value of cost of sales and gross profit. If you have marked all, you may continue to the next learning unit. If you have marked any, you have to revise that specific section. If you have marked any, you have to restudy that specific section.